In this video, I'm going to cover the balance of payment accounts. The balance of payment refers to the balance of trade, which includes only goods and services, but the balance of payments considers all international transactions. The BOP is a summary of a country's international trade, and it's within a given year prepared in that country's currency. So, for example, the BOP for the US would use the dollar. There are two accounts that make up the BOP, the current account as well as the capital and financial account. The current account is made up of three different parts. First of all, trade in goods and services or net exports. So the difference between a nation's exports of goods and services and its imports of goods and services. So toys imported from China, US cars exported to Mexico. Investment income refers to income from the factors of production, including payments to foreign investors. So an example would be money earned by Japanese car producers in the US. And the third are net transfers, or money that flows from the private or public sectors. Examples would be things like donations, aids, and grants. The capital and financial account measures the purchase and sale of financial assets abroad. So purchase of things that continue to earn money. So for example, a Korean company that buys a factory in Ohio, an American that buys a Japanese government bond. When a foreign company buys business in a different country, that is referred to as foreign direct investment. Net capital outflow is the difference between the purchase of foreign and domestic assets purchased by foreigners. A financial account surplus means that the inflows are greater than the outflows, and a deficit means that the inflows are less than the outflows. The current and capital and financial accounts must balance out. So if one has a deficit, the other one must have a surplus. So the current account plus the capital and financial account must equal zero. And why do these two have to balance out? When one country buys more exports than its imports, that extra money, so to speak, is used by foreigners to purchase domestic financial assets. Money that leaves a country has to come back as either foreign purchases of goods and services, which we refer to as exports, or foreign purchase of financial assets. Next, we're going to draw the aggregate demand and aggregate supply, as well as the loanable fund markets for both the US and China. We're going to consider the aggregate demand and aggregate supply graphs for each country as the current account. It's not exactly completely true, but it's close enough. And then the loanable funds market we're going to consider or think about as the financial account. Assume that the US and China have balanced trade. What happens on the graphs if the US imports more from China? In the US, aggregate demand would fall because net exports are falling. And in China, aggregate demand would increase because net exports are increasing. In China, the supply of loanable funds would decrease and the real interest rate would go up. In the US, the supply of loanable funds would increase and the real interest rate would fall. So in China, there would be a capital flow that would fall, and in the US, the capital flow would increase. So the US would have a current account deficit. China would have a current account surplus. The financial account, again, has a capital flow that would fall in China. And in the US, that capital account flow would increase. Consider each of these examples and determine whether they're included in the current or the capital account and whether that would result in a credit or a debit for the U.S. And here are the answers. And here is more practice with the answers. And a review question, and the answer is B. And here is a practice FRQ along with the answers.